Welcome to the latest episode of Just Some Musings. This latest episode was recorded in mid-October. Apologies to our loyal listeners. Took a while to get around to finishing this one off and editing it with some additional travel and a lot of catch-up work in the office here. In this one, we talk about our travel in September, including Justin's trip to Japan and my conference circuit, some interesting technology and the application of AI in our wealth management industry, and also what I've noticed at both the conferences I attended, the proliferation of alternative investments in terms of marketing. We talk a bit about that, and that's why I titled this episode Gung Ho Over Alternatives. And finally, we finish things off musing about the value of fictional characters and gold. Enjoy.
So if I fall asleep, you know why, because I just got back literally I'll not say 24 hours, but you and I have actually had some travels over the last month. It's been a little while.
Why don't you start? You were in a lot more interesting places than I was.
Well, I don't know,
Much
Japan has the same latitude basically as like as Los Angeles, Tokyo, right?
Oh, really?
So the weather was great, humid, and then I came back to Calgary and there's snow in my backyard. I was like, oh, I guess it's happening. It's already happening.
Yeah, not here.
But nevertheless, yes.
It's always Calgary that gets things confused and thinks it's winter in October, right?
Yeah.
You realize it's still fall here.
Happen? So I will admit that we, as a family unit, we kind of brought forward a vacation block of time into the end of September, beginning of October, for the main reason that it was kind of our speculation was that there's probably going to be a formalized strike or labor action by the teachers union, and so we sort of thought that more so. My better half thought that if the kids are going to be out of school for a little bit, maybe we just take them out of the country too. Mm-hmm. So the timing sort of worked out on that, and so yeah, we just moved forward a trip earlier, and it was lovely. I mean, you've never been to Eastern Asia, right? Or
no, someplace I still want to go, especially Japan.
Yeah, everyone and their dog is going to Japan over the last couple of years, and this year and into next year, and for a number of reasons. And I think that there's obviously incentives as to why. The United States is a little bit more expensive, with the foreign exchange. There's also a broad sentiment of kind of still keeping some elbows up or selectively choosing vacations, right? And not perhaps going down to the south nearly as much, as a country as we would have in the past. And so what are the other alternatives? Stay within the country, go domestic, maybe look at Europe, overseas. Japan is a year-round direct flight from Calgary now. And so foreign exchange, I mentioned that, the Canadian dollar versus the Japanese yen is quite favorable at these days, particularly compared to historical exchange rates. And so it's almost on, I want to call it like a 1 to 100 yen basis. And so things are very affordable, with the exception of hotels. But food and transportation and all of that is quite affordable. And lastly, what I would say too is that with the melding of cultures, I've made a comment to other people that you can buy sushi at basically the convenience store here, right? Certainly at the supermarkets, everyone eats sushi now. It wasn't like that when I was a kid. I brought like Korean rice rolls, gimbap for lunch, and people are like, why are you bringing sushi, right? But now it's completely normalized. Like kids are eating sushi and tempura and what have you at a very young age, ramen. And so it's something that people are accustomed to. It's been a number of years since pre-pandemic since I had been to Japan. And while some things are changed, some things are definitely the same. And it was nice to go back and then introduce the children again to like a different culture and get a glimpse, boots on the ground. In the investment world these days, like Japan finally, it's kind of hit an all-time high again after like 30 odd plus years of like floating around doing nothing. And Japan has also been a key area of diversification for portfolios, especially when people are looking to diversify outside of North America. It's still one of the largest economies in the world. A lot of things happening from there. And so it was good to see that boots on the ground in some ways as well. And I can go about it into more detail, but Yeah, that's where I was the last couple of weeks. But before that, you yourself were traveling too, and you'd gone to a couple places as well. Um, Tell me a little bit about those.
Can we just touch really quickly on Japan
Yeah.
being at all-time highs? This is something I shared on Twitter a week or so ago.
Mm-hmm.
It's October 2nd. Every major index in US dollars, in this case, just to
Yep.
keep things even,
Sure.
all at all-time highs. Like all, and you look at some of these, like emerging markets, for example, which up until
Mm-hmm.
probably earlier this year was still at a point where it was below its 2007-ish high. So yeah,
Yeah.
finally everything breaking into all-time highs. Japan is still holding up the rear here,
Yeah.
but still 315% for the and this is going back to the year 2000, so that's for the whole millennium.
Mm-hmm.
I guess it's going back.
They got a new prime minister now. There might be some changes.
Yeah, the U.S. is still, of course, way in the lead, but maybe at some point we see a little bit of switching around in the leadership here. And
Yeah.
we talk
I mean,
about that for a while. At least, there've been a lot of pundits talking about, maybe Europe is finally starting to pick up this year. Canada, Europe, Japan, I think have all outperformed the U.S. So we'll see what happens.
yep. Yeah, and that blue line there, up until like 2020, was not the top, right? It was the green line.
You
It
see
was the
that here,
red.
yeah. It was the laggard for a while. And nobody wanted to buy US stocks back then. That was when I started. Nobody wanted to buy US
Yeah.
stocks. And now everybody only wants to buy US stocks.
That's the
Obviously the
paradigm. Yeah.
rational thing is to be diversified and to, own a bit of everything and not base your decision on what has been doing well recently, because that didn't work out so well back here. Everyone wanted to buy emerging markets back here. Latin America funds, China, India funds, BRICS, all that stuff.
Bricks.
It was the worst
Mm-hmm.
time, the absolute worst time to be buying them. Canada, too. Most investors here were 90% Canadian, had a little smidge in the US, thought that was
Yeah.
diversification. Lots of energy stocks, and things turned, obviously. That's never the right way to invest, to base your decision to overweight something based on what has done well recently.
And again, you can have systematic like paradigm shifts too, right? Like I remember being in Fort
Mm-hmm.
McMurray during the heyday, the commodity boom, super cycle, whatever you want to call it, when China was going to do everything, buy everything, build everything. And frankly, that's why I got my job out of school up in Fort Mac, was because of that, right?
So you wanted to know about my travels.
Yeah, tell me a little bit about California and BC and some learnings there.
Yeah, so unlike you, I did travel to the belly of the beast, the United States of America, the evil empire, I guess. And yeah, it was actually pretty painless flying there. I got myself a Nexus card last year. Really, I started applying for it in 2023, finally got it in 2024 after my last trip to
Yeah.
the US.
Yeah.
And other than my trip to Europe, where it was actually useful as well, and then re-entering Canada was useful. But other than that, I hadn't actually used it to get into the U.S. And I was amazed at how seamless it was. Just put the card in the machine and knows who you are, and they ask you an easy question, and you go. Flew into the Santa Ana airport this time because it was closer
Okay.
to the conference. Didn't want to go
Yeah.
through LAX and take a $100 Uber from there. Kind of an efficient run airport in a way because it is extremely busy. It is probably a third the size of Edmonton's airport with probably 5 times the traffic or more.
Mm. Mm.
And lots of, just, I don't know about total traffic, but lots of takeoffs and landings, like literally constant the whole time
Yeah.
on one runway.
Mm.
But yeah, the conference, same conference I've gone to the 2 previous years, the Future Proof conference in Huntington Beach.
Mm-hmm.
Another great time. Lots of Canadians this time. So
Every year there seems to be more and
5,000
more.
attendees. Yeah. 5,000 from all over North America, and 400 of them, they say, were Canadian. And you're right, more and more. I hardly ever see anyone from the major banks there. A few from some other quasi-independent dealers, and you can kind of see there's a certain tribe of advisor that are looking to prepare their business for the future, both in terms of practice management, gleaning a little bit of what's going on in the US, where they're 10 years ahead of us and everything.
Mm-hmm. Mm-hmm.
Also seeing that the new technologies that are around. they have these one-on-one meetings, and I had this time I lucked out, and a lot of my one-on-one meetings were with technology providers. Previous
Okay.
years, it was just a lot of product that was being sold,
Yeah.
different fund companies and whatnot, which
Yeah.
didn't
Yep.
really interest me. But talked to several different companies offering similar types of basically the next step with AI note taking, where right now we already do employ AI note taking via Zoom and Teams, being able to sort of summarize what we talked about.
Mm.
The next step of that is the newer kind of more, I guess, customized note takers for our industry. What they do is they actually are able to clue in better to the financial planning conversations we have with clients. So that is to say, if we start a conversation off talking to a client and sort of shooting the breeze talking about weather, it's not going to give 2 paragraphs about the weather. They clue into specific details that matter to a financial plan. It's gotten to the point where it's possible. I don't know how many firms do this at this point, but it's possible to use them for client onboarding, meaning you have that initial interview with a client over Zoom or whatever, even in person using your phone to capture the details. And the AI app will capture those details in terms of what to put into the account applications about, age, job, address, things like that. There's, of course, the big challenge in implementing something like that is how does that information get stored securely and used
Personal
used
data.
in a proper
Absolutely.
manner. Yeah. So
Yep.
there's still challenges around that, but it is theoretically possible. And I know of at least one financial planning platform that is using sort of an AI note-taking app to gather the data through conversation and then basically plug that into the financial plan. So again, trims a lot of repeated work so that, for example, and this is just the future that I see for financial planning. You have your conversation with the client, hour-long conversation, finding out all about their situation, their goals, and everything. And when you finish the conversation, not long after that, it's all implemented automatically into a financial plan, into account applications. And in terms of what other work the financial planner or their admin assistant needs to do, there isn't a whole lot of extra work to do. Most of it's kind of taken care of. You just sort of probably make a few corrections here or there, but it trims hours and hours of work. And that's that was probably the most interesting technology that I saw coming out of that one. Previous years, there were other presentations more having to do with portfolio management. I think we talked about that in past years. Yep. But yeah, so that was the conference in California. It was nice weather every day. So then I flew back and I was in town I was in the office for a Friday and then in town for the weekend. And immediately Monday, then I embarked on a massive road trip, starting with a couple of client meetings in Calgary and Southern Alberta, driving over into BC the next day, visiting my dad in the Okanagan area, and then continuing on to Vancouver Island. Well, first I met with a colleague in the Vancouver area. And then on Vancouver Island, I stayed in Ucluelet for a couple of nights, did a little bike trip from Ucluelet to Tofino and back.
Oh, that's a bike ride. That's
85 kilometers, but it was with an e-bike, so not quite as impressive, but still I didn't go, full pedal assist the whole way, but I just had a little bit of help on the hills. But beautiful, beautiful air. It was sunny that day when I was biking, and really a great part of the country to see. And I haven't seen it in many, many years. But then the reason what drew me to Vancouver Island was the Institute of Advanced Financial Planners Symposium, which took place the week after in Nanaimo. And that was Wednesday to Saturday with many of the top financial planners in Canada and some great presentations. Relative to the Future Proof conference, it was much more of a brainy conference, I would say. More thinking. Like the conference had a case study that was referred to throughout, and it's not all fun and games. I mean, there's certainly some fun afterwards, but the very, very valuable conference. Many continuing education credits out of that one.
Yeah.
One thing I wanted to remark on with both conferences, and here we see a similarity between the wealth management industry in the U.S. as well as in Canada, is a massive proliferation of alternative investments, private equity, private credit, private REITs, everything under the sun, everything but basic vanilla mutual funds in terms of sponsorship. Like there are tons and tons of sponsorship dollars, marketing dollars coming from various purveyors of alternative investments. And
Sure.
yeah, I saw that Future Proof where where
Yeah.
they basically put up booths all along the parking lot that's next
Yeah.
to the beach.
Yeah. Yeah.
Many of those were those types of companies. Not, you hardly even see. I mean, there's a Vanguard booth, there's an iShares booth, but many very niche, unique, private, whatever
Yep.
investment strategies. And conference in Canada, similarly, a lot of REITs, a lot of
Yep.
mortgage investment corps, those types
Yep.
of things. Only Fidelity in terms of mutual fund companies. But what it kind of shows you is the mutual fund companies aren't throwing around the type of marketing dollars they used to. And I mean, just to kind of backtrack, these types of conferences depend on some marketing, some sponsorship. Otherwise, they end up being extremely expensive for us advisors to attend.
Yep.
Um,
Oh, like any conference for sure.
like
Right.
any conference, yeah.
You
I
need
mean,
sponsors. Yeah.
I should say nobody paid for me to go to these things. I still have to fly myself there, pay for my own accommodations.
Mm-hmm.
But then there's also a cost to attend the conference. That cost, typically, the way they do these things, it's a small cost for advisors to attend, and obviously it's because we are a customer. And for any company that wants to attend as a sponsor, there's a much higher fee for them to attend as persons, and then
Mm-hmm.
there's of course a sponsorship fee if you want to have your name on the board or you want to have a booth or do a presentation, for example. What I think it comes down to is the fund companies. I mean, we know they're struggling. Actively managed mutual funds are seeing a lot of outflows. They used to be the bread and butter for people like us, right? And a lot of customers, even if they were do-it-yourselfers, they were still buying a lot of these funds in their discount brokerage accounts. That's not happening so much. There's a lot of money flowing out of it. A lot of these fund companies also have their own index funds, and they're moving money, or they're seeing the fund flows going from their active funds to their index funds. But obviously, that is causing a lot of compression in their profits, right? Because they're not charging 1%, they're charging 0.1%. And so they're all kind of reaching for some other products that can be more interesting, maybe a little bit more opaque and harder to understand, also more unique that you can't really buy as easily as an index product. And that seems to be, I don't know if a lot of money's flowing that way, but a lot of marketing dollars is coming out of that area. I don't know if you've seen that too yourself, Justin, in terms of people calling us, the wholesalers
Oh,
calling us and
absolutely.
things like that.
Absolutely. I mean, tell me when they put a name on the new sports arena, right? I mean, every sports arena in Canada either has a bank name on it or a telecom name on it, right? And that's what they're doing. They're reaching out and making sure that they have visibility, that they have a brand awareness. I'm happy to chat about brands as well now that I think about it. But yeah, there's an evolution, right? Years ago, it was difficult even to invest, right? Not that long ago. And then the advent of the mutual fund sort of helped spur Mr. and Mrs. Smith, right, to invest. And then it came into, discount brokerages, online, index funds, ETFs. ETFs now, like it's a whole argument. We've talked about this umpteen times. They're not necessarily passive, and they're not necessarily cheap either, depending on what index fund you look at, right? And so there's an ongoing evolution, and I think at this day and age, different mandates that are coming in that are wrapped or put into a package, an investable vehicle that can be accessed by people that in the past it was either unavailable to them or inaccessible, right? And so I suppose it's anything new like that. I take a little bit more open liberal approach to it, whereas like, okay, yeah, I get the fact that there's a lot of businesses out there that are quite good, but maybe are not publicly traded. So I suppose though, just recently, yeah, there's been a bit of a more of an evolution. I do think there are obviously dollars flowing into it, otherwise they wouldn't be doing it. As much as you said that Canada's 10 years behind the United States, I think down in the United States, the proliferation of private investments is well on its way. And even if one may or may not necessarily use it or like it, and I suspect that in the incoming years, more and more clients, advisors will be utilizing those products. The pension plans, all the Maple 2008 and whatnot, they've been investing in private assets for decades now. They kind of originate. Canadian pension plans were at the forefront of that, right? So I suppose I'm somewhat surprised that it took this long for it to come to Mr. and Mrs. Smith down the street, or Mr. Mrs. Advisor, that either us or that we work with. So it's happening. I don't think it's stopping. I think those sponsorships will probably continue to increase, maybe in a decade or so become as commonplace as a Vanguard iShares index fund, potentially. Or if not, certainly put into, say, for example, a target date fund, whether you appreciate it or recognize it or not. Right. So I feel it's almost inevitable. It's inevitable, I feel. Right. And so if you saw in the United States that there was a lot of interest in it, I suppose that we'll eventually see more and more of that happening here in Canada.
Thing is, I don't know how much interest there really is amongst the advisor crowd. There certainly is. When the advisor puts it in front of the investor client, there is a lot of interest because it's an interesting story.
Yeah.
It's a whole lot more interesting than we're just going to buy some index funds.
Absolutely.
And
people
especially,
like exclusivity. You got to put up a velvet rope. You got to make things look interesting.
It's exactly that. It's exclusive looking. And, we hear the same arguments made by those companies in terms of why you should buy them. Canada Pension Plan has a lot of private equity in it. You need to have this for diversification. It's a uncorrelated asset class. The volatility is much lower than equities. The volatility one, I think, is complete BS, really, to be frank.
That's a good debate.
You've got an asset that, at best has liquidity once a month. Of course, it's less volatile than something that trades openly on the market every single day, throughout
every
each day.
Second. Yeah.
You only need to look at the markets today as we record this. You don't see that type of volatility on a private asset or a home or whatever, because today is October 14th. We saw the markets open really down, and then they were quite a bit up, especially small cap, it seemed, and then went down at the end just because of a Trump, I was going to say tweet, but whatever he does on his own social network there. But we hear these arguments. I get it, and I'm not completely against alternative assets. I use some myself in my in my portfolios. Small amount though, like probably 6-7% at most, depending on the asset allocation.
Yep.
And what we're also hearing is, one of the major banks, I'm not going to name any, but one of them said we're kind of gearing towards having, what did they say, 35% of client assets in privates. Which I think is insane. The pension plans have quite a bit. And now maybe there was a benefit for them to have more in private assets at a time when they weren't as proliferate among retail investors. Yes. So there was, that illiquidity premium kind of, that is something that not everyone has access to. It's not being priced in the open market. There isn't a ton of capital flowing into it, so you can buy it cheaply.
Yeah.
But now it seems, maybe in a way to get more assets, more capital flowing into these alternatives. And alternatives I'm really using very broadly to mean private equity, private credit, private REITs, mortgage investment corps, all sorts of things that are not stocks and bonds, all these other things that these various companies want us to buy. So they're trying. Maybe there's not enough capital anymore in these big pension plans to go into these assets. Perhaps because of a retiring boomer age class, money is starting to net flow out of these pension plans. Maybe that's why they're reaching out to retail investors, trying to get capital in that way. But let's say they're really successful and they get a lot of retail money flowing into these things. Eventually, these things are going to be overpriced, and you're not going to get the same benefits that people did in the past, whether they were institutions or just high net worth people that had access to these things. If everyone's flowing into it, private equity shares or whatever it might be, if everyone suddenly has the ability to buy into this, that is basically a public stock, and it's going to trade at a valuation like a public stock, and there's no longer really any benefits to getting into it cheaper before it goes public. It'll go public, and then it'll basically sell down when it goes public, probably. But anyways, the biggest concern I have, and this came up in a recent podcast I listened to, Rational Reminder, just last week, and they interviewed a guy, I forgot his name now, but he mentioned somewhere in the conversation, he has his biggest concern about it all is that nobody is second guessing it really. Nobody's critical of it, or not enough people are. Everyone's just saying, yeah, let's do this. Let's all go gung ho into all these different alternatives. And again, it's working for these fund companies. It's getting them assets into these unique, exquisite products. It's working for a lot of advisors. It's getting them assets where they can go, do seminars about this and share, what they're doing and how it's so special. But yeah, I kind of worry when everyone's kind of really gung ho about something like this. I started in 2007. I don't need to say much more. People were really gung ho about, subprime mortgages and stuff. Like nowadays it sounds crazy. Why would anyone want subprime mortgages? But at that time, people were like, this is where the money's to be made. And this diatribe after this. One of the presenters at the financial planning conference, and I'm not going to name names again, but this is a company that advertises quite a lot on BNN. They advertise their investment on BNN, and then you see they advertise to their end clients on regular networks, basically lending money. Yeah. And they talked about their product and what it really is. And hearing them explain it, it scares the bejesus out of me in terms of, again, as someone who was kind of conscious about what was going on prior to the financial crisis. This company basically does literally subprime lending, people who can't borrow money at the bank, and often in second position mortgages. And at really high interest rates, like I think average, they said 12% probably average interest rate. And then they sell their products, their investment product, again on BNN. Of course, talking about the great yield it makes. And I'm sure a lot of retirees looking for that yield are very attracted to that, and rightfully so. But do they understand what kind of an extreme level of risk is in the underlying? Like this is not going from a GIC at 3.5% to something the same risk at whatever they're offering, 8 or 9, maybe 10%. I think they showed some historical numbers. They did something like 9%. I mean, again, it's working for them. It's not the investment's working so far, but I'd be really cautious about that. Like I would not expect to get a risk-free 9% lending money that way. One of the things they mentioned in their presentation was their loan to value of their mortgages on average, something like 55% or a little over 50%. So that sounds great, right? But I think someone asked them later on, is that based on current valuations or 2023 valuations?
Yeah, whatever 2024 is appraised at. Yeah,
a lot of those mortgages are in Toronto and Vancouver area.
Sure.
And those properties have come down quite a bit in value. So that loan to value is going to be higher. And, what happens if there's a more significant decline? I mean, a lot of the people they lend to are people that just, they lucked out and their home values went up a lot. And as a result, they were able to borrow some extra money, take care of some debts. And of course, they're happy to lend money to them. But anyways, that's kind of the worries I have in a microcosm sort of way.
One thing I'm particularly concerned about these private vehicles is that, aside from the comments that you mentioned as well, is that they're supposed to be uncorrelated to the public markets, generally speaking, right? And yes, it depends on whether they make their mark. They don't do it at the end of every day. They might do it every month or every quarter or who knows when, right? But the underlying investments, to your comment about what's inside of them, often tend to be things that would normally be in the public markets or are very tied to the public markets. So for example, on a broad paintbrush, I've seen private credit funds where a lot of their investments are in AI credit, debt, right? There's an explosion, right? We've tens of billions, hundreds of billions of dollars that hyperscalers and tech companies are looking to use or to spend on AI infrastructure or under the guise of working towards AI and building better models. And where's that money coming from? Yes, they're using profits, but a lot of them are also borrowing. And there's a lot of companies, OpenAI being one of the prime examples, that they're not really that profitable. They're not profitable, really. They don't really have a ton of revenue, but they've got to buy a hell of a lot of GPUs and infrastructure. And so where's that all coming from, right? Mm-hmm. They're raising money, either equity or debt. And where is that equity and debt being held? It's largely being held in private credit, private equity funds. And so it is tied to inherently, what is like the number one driver of the US stock market right now, for example, is the AI trade, right? And so even though they say it's uncorrelated, or these things, these vehicles are supposed to be uncorrelated, more and more of them are investing in things that are directly tied to the key driver of the public markets. And so it might be one thing to buy into a private equity fund that owns like a hydro dam or a toll road, in Ontario, or an airport in India, right? But just to lend money to AI hyperscalers, well, that's like, you can kind of see that already happening in the public markets, right?
I worry too when you don't have valuations happening mark to market every day. Yeah, it might make things look not so bad. I'm sure they look great.
Volatility
when everything else was down,
right? Yeah.
Well, when everything else, exactly, volatility laundering is a term I've seen thrown around. But yeah, like you think of April when the markets were down a bunch for a couple of days. In that same time period, whatever happened to be the asset class we're talking about, it just didn't have to market on April 8th. Maybe it did at the end of the month, and you didn't see anything, and thus the investment looks less volatile.
Then you had to wait 22 more days before they marked it again, and by then, who knows, right?
Yeah. And then too, when you have some of these things too, when they actually do mark to market, how do they do it? What's their process? Actually, one of the great presentations we had at the Financial Planning Conference was put on by Aravind Sithamperpillai. He presented on evaluating those types of investments. Great presentation. And he talked about things like that. Really, that's a presentation. I hope he does again somehow, or maybe puts it online where it's more accessible to more advisors, because he really delves deeply into a lot of those things, a lot of the ways some of these companies maybe, I'm not going to say fudge the numbers a little bit, but how you need to look beyond the numbers sometimes. Sometimes the way they value their funds.
The quick counter argument, or the go along with that, is that sometimes you don't need to see it. If we're trying to tell people that don't look at your accounts every single day, then maybe there's a point to be said that they don't need to market every single day either, right? One thing really quick, I thought about the life cycle thing, and it reminded me, actually, if I can go back to my my trip to Japan, we spent a day at Disney Sea. And Disney Sea
is
really
actually cool.
Yeah, and it's not.
Some videos of
Disney. You saw some videos, yeah. So it's actually not actually owned by Disney per se. It's licensed. It's owned by in the parent company is a railroad company in Japan. Talk about conglomerates, right? Nevertheless, the comment I wanted to make is that my kids didn't know who Peter Pan was, and this is old school Disney. Like there was princesses, and yes, there was they knew certainly who Anna was, Elsa was, right? They knew, at the other theme park, they knew Harry Potter. They certainly knew the Nintendo characters, right? But it was interesting to see that, like, for a company like Disney, for example, and there was old stuff like Mickey, they weren't interested in Mickey. They weren't necessarily interested. I had to explain who Peter Pan was. We went on a ride and like, oh, this is Peter Pan. This is Hook. This is Tinkerbell, right? And it made me think about how I think of, like, for example, Disney or Nintendo or any other franchise that is, is supposed to have a lot of intellectual property. And a lot of the investable market out there is based off of intangible assets now. It's not physical assets so much more, especially the technology companies. It's all IP and intangibles. So nevertheless, what is the value of Peter Pan versus Elsa, right? I can tell you which one's more popular right now. What is the IP of value of Mario to Pikachu, right? It's probably different. It's quite different, in fact, right? There's longevity, right? But things evolve over time, and brands change over time too. And while I'm waiting in line to go on a ride, I'm thinking about like boomer or like older school brand names. I'm thinking like Harley Davidson explicitly, right? Which is a very popular, powerful brand for a certain demographic. But in this day and age, very, very, less popular. And even Disney, you have to constantly reinvent, which is kind of like why they had to buy, Star Wars and Marvel. And even then, they're constantly evolving those storylines and those universes as well. Right. So it did just sort of made me think that, constantly that things are changing. Things, there's a life cycle of businesses. There's life cycles of intellectual property. So how do you value that appropriately? And they still are worth something, but they are a fraction at this point in time to Pikachu and Hello Kitty and other names like that, right?
Some do it really well.
Some do
Some
really
don't.
well, and others say, you know what, I'm happy selling cigarettes, and I'm not changing. I'm not even selling e-cigs. I'm just selling cigarettes. I'm gonna churn out that dividend as long as possible because that's who I am.
Well, those companies
I'm,
almost don't need to change, but
no,
some companies say this digital photography thing is a fad. We're going to keep making film cameras, and then
well,
other companies,
arguably this thing is actually more so a camera for most people than it is anything else, than a phone itself, right?
I mean, you think of how Apple evolved over the years, and I mean, it always had
these things in my ear.
Brand name always had a following, yes. And they're not making PCs or laptops. I mean, that's not their main business.
They're making accessories. They're making AirPods. Constantly having to look to evolve or develop and be, in some senses, to go back to the term you used earlier, future-proof ourselves, right? To make sure that we are evolving ourselves in some form.
Just to finish things off, something that is not really new or exciting, but I'm wondering, is anyone really talking about gold lately? Like, have you seen the price of gold?
I heard about it. Yeah, I mean, I remember not that long ago, this year, a few months ago, it broke 3,000. That was a big deal, and now it's 4,000 USD. You're right. I'm talking, per ounce. They love shiny things, and it's doing really well. It's the number one asset class, I think, in 2025, isn't it?
Yeah, it has been this year. This what I just put up on the screen is actually the decade so far. So 5 years, 17% annually, and that holds up against even the stock indices. I think the Nasdaq maybe did a little bit more than that in that time period, but it's a pretty darn good investment. And I just bring this up because I remember 2011, when gold and silver was hitting highs, and everyone was talking about them. Everyone wanted to buy precious metals fund at the bank where I was at, and everyone was, buying gold deposits, gold certificates, and whatnot. It was, for some reason, people go after the shiny metal when its price is at its highest, but that's just kind of human nature too. But yeah, I kind of looked at this, and this is kind of a blog post I'm working on. It'll probably be out by the time this publishes. Looking at gold over time. So like, you look at this chart. If I wanted to sell you on gold, you probably would go for it, right? This chart looks awesome. There's hardly any volatility. It just went up. Great investment. I want to buy that, right? And that seems to be how a lot of people think. If you change the x-axis, and it completely changes the narrative upside down several times. So I went and looked at, this is even better. This is from 2000 to 2025. Gold has done phenomenally well. It didn't lose money when there was a financial crisis. It has some stumbles here, but overall, 10.5% annually over the 25 years. And you think 25 years, that seems very long-term. So, if it did 10% over the 25 years, we can trust that maybe it will do that. I don't know. And, stocks, and this is total return of U.S. stocks, surprisingly low when you think about it. Nobody thinks about how low the return of stocks was if you use the year 2000 as a starting point. So yeah, again, gold looks awesome. But then you go back even more, and now you look at 1980 as a starting point. Yeah. And this is cherry picked to be the highest point in September of 1980.
Yeah.
And 45 years, and it only averaged less than 4% annually. Yeah. That's terrible, right? At inflation. Yeah. For most of those 45 years, it was trailing inflation.
Yeah.
Looked terrible. And of course, U.S. stocks look much, much better. And what I'm getting at with my blog post is not necessarily gold is very good to invest in or gold is really terrible to invest in, but you can keep flipping the narrative, do complete 180 on the narrative just by zooming out, by using a different perspective. And if you zoom out even more, this has 1970 as a starting point. Now it looks awesome. Now, this may be kind of segues to our previous discussion. Why did gold do so well from 1970 onwards? You had this huge ramp up to 1980. This was because the price of gold was suppressed artificially for a good long time, from the 1930s until 1971. they were suppressing the price of gold versus the US dollar by basically propping up the value of the dollar using gold. When they stopped doing that, when they allowed it to float freely,
get off the gold
then the
standard,
markets showed how overvalued the dollar was, the US dollar, and how undervalued gold was. And we saw that imbalance kind of rectify itself. And again, that's the kind of thing that can happen when you have asset classes where they're maybe kind of artificially propped up or propped down or whatever. That can happen. If you went even farther out, and I don't have a chart going back that far, but if you went to like the last 100 years, the annualized return is back to being something, it's probably about 5%. I think 5.4% annually is what I calculated.
Yeah.
That is 1925 to 2025. Price of gold from $20 to $4,000. It has had some times when it really shined, but it's not been a really good investment. It has been very volatile, just like stocks.
Yep.
No income, no interest, no rent, no dividends.
But it's
and
nice
there
and
have been
shiny to
times
look
when
at.
it was, yeah. I'll bring
And
my,
it's having
I'll bring
its
my
moment.
gold coin as show and tell next time. But
it
has had its moments,
for
but
sure.
then it can have these, like stocks don't have that. Stocks have had 10 years, maybe 15 years of secular bear markets in which the stock markets went down overall. Gold has had, in this case, we're seeing periods of time of 20, I guess it was 20 years from 1980 to 2000. And then it took another 10 years until you saw recovery just in nominal value of gold. And historically, it has gone 150 years in bear market. When they started bringing back all that gold from the New World, it devalued the price of gold by 80%. And this is like in the year, this is way back when, I think 16th century to 17th century. And then it took until 1850 roughly for gold to come back to its value from 150 years prior. So yeah, that's the type of asset gold is. You have to be really thinking long term, if anything, and otherwise, I'd rather own assets at least pay me something while I wait.
Awesome.
Okay, we'll leave it at that. Any views discussed in this podcast are those of the presenters or any guests and not necessarily those of Canaccord Genuity Corp. Statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as securities broker or dealer in any jurisdiction. All views expressed are intended for general circulation only and do not have any regard to the specific investment objectives, financial circumstances, or general needs of any individual, organization, or institution. Investing in equities is not guaranteed, values change frequently, and past performance is not an indicator of future performance. Investors cannot invest directly in an index. Index returns do not reflect any fees, expenses, or sales charges. Please do not hesitate to contact us should you want to know more about anything discussed in this podcast. CG Wealth Management is a division of Canaccord Genuity Corp., member of the Canadian Investor Protection Fund and Canadian Investment Regulatory Organization.